Hello, everybody, and welcome to Leading Indicator, a show by Public.com bringing you insights from the world's best macro minds. I'm your host, Kinsey Grant, and we are here with you today to discuss the energy sector and a possible supply crunch for oil. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help you keep up with the latest investment news. Today, we are here with Josh Young, a portfolio manager at Bison Interest. Josh, welcome to Leading Indicator. How are you?
I'm good. Thanks for having me on.
Of course, I'm happy to have you here. We got a lot to cover, a ton of great big ideas sort of floating around in the energy sector. We're going to hit on a lot today. So if you're ready, shall we get started?
Let's do it.
All right. So I think it has certainly been, an interesting story. I'm sure interesting is a fair word here for the energy sector after the S&P 500 energy index grew around 60% in 2022, but that same index has remained relatively flat throughout the first half of 2023. We're recording this right at the midway point of the year. Can you offer a little bit of context as to why those returns were the reality in 2022 and what's changed in 2023 to make that a different reality?
Yeah, it's a great question. I think we have to rewind a little more to get some context. So I think when you think about what happened in 2022, it really started in 2014 with the last peak of the shale cycle and of the oil cycle. And so oil prices had risen for a decade to a decade and a half previously. And in 2014, as shale oil production growth started to take off, the market started to be oversupplied and oil prices crashed and stayed relatively low as shale production here in the US, in Canada, and a couple other places grew substantially and sort of overwhelmed the market. And so what happened was starting in 2018 or so, shale productivity sort of peaked. And as it peaked, activity didn't slow yet, but the incremental growth from activity, the incremental oil production growth started to slow. So the second derivative slowed first. And then what happened in 2022 is after the COVID slowdown and then the restart, we started to see actual production disappointment. So it took a few years for it to play out. And then when Russia invaded Ukraine and there was a lot of supply concern, you saw oil prices go crazy, essentially double from where they were in the prior year. So that's that was the background for 2022. And it's worth highlighting that because here we are in 2023. And on one hand, Russian production and Russian oil supply to the global market has surprised to the upside. So that whole thesis around Russian supply disappointment was essentially either early or wrong. But we're still in this longer cycle where there were many years where there was insufficient investment in oil development, at least longer cycle. Shale is very short cycle. You spend the money, you get production a few months later, and then it declines really fast over the following year and ends up being almost inconsequential after a couple of years for any individual well. So we're sort of through the growth from that. And we're in this period where the longer commodity cycle is starting to kick in. And so it's been very weak as people who expected Russian oil production disruptions have been disappointed, and the market sort of had to process that along with recession fears. But we're still sort of in this context of underinvestment for a long time, along with a lot of negativity to the industry, which is withholding investment despite sort of the obvious supply concerns.
And what is behind the negativity being directed toward the industry? I mean, I imagine the answer is relatively obvious, but I would love to hear your perspective.
So I think actually the biggest thing is negative returns on a 10-year basis. And so that's just sort of obvious, right? When things are bad for a while, the longer they're bad, the more people that have sort of gotten suckered in and lost money, and the more hesitant those same people are to come back in. And then anyone that hasn't invested feels sort of more and more validated for having not invested. And so you have many investors whose whole investment experience, if you started investing, let's say 10 years ago or even 15 years ago, your decision to not invest in energy has been reinforced, and your decision to invest in energy has been mostly punished over the last 15 years. And then what you saw there were a set of people who were quite adventurous who invested in energy for the first time in 2020 or 2021, and they did extraordinarily well. And then if they stayed, which almost everyone did, and then if they put more money in, which almost everyone did, in 2022, they got their faces ripped off because even if the sector is roughly flat, the reality is most incremental money was going into smaller cap stocks, which are down considerably. In some cases, they're down 40 or 50%. A few of them are down way more than that from their high last year. So there's sort of this really tough dynamic. Secondarily, there's a lot of concern around ESG and climate and the transition to alternative energy. But frankly, that's more of a factor in withholding capital and investment for supply, and that's less of a factor really in terms of demand. And today, the day we're recording this, the news is that the Energy Information Administration, the EIA, materially underreported oil demand in April. That's the most recent month that they have sort of comprehensive data, and they revised up demand by almost 800,000 barrels a day by about 4%, that's a totally unacceptable. The error factor is supposed to be like 0.5%, not 4%. And so anyway, I think it's indicative of the real sort of sustained demand and sustained oil demand growth, despite that sort of ESG narrative. So I would put that aside. Really, the big thing is just negative returns for a long time. Anyone that ventured in got their faces ripped off, lost a lot of money, or if they didn't venture in, they got reinforced that they should just keep buying tech or keep buying healthcare or whatever. And so from my perspective, it's great because the more it's hated, the lower the valuations are, the easier it is for stocks to go up when eventually the cycle has turned. And as the supply crunch plays out, there's a lot of room. There's very low expectations in the industry and very ultra low expectations on small cap stocks that trade at a big discount to the overall sector, where there's the room for things to move a lot and then to stay high potentially for a long time, similar to what we've seen with other sectors as well as oil in past cycles.
All right. On leading indicator, the goal here is to talk about some of these big macro trends that are going to impact the sector in question today. That's energy, oil, pretty specifically. And I think that it's fair to say, given what you just explained, that market psychology can be a pretty significant macro impact on a sector. I'm curious to hear how the reality of a potential recession, or depending on your definition, a literal actual recession, how that impacts energy. What is typically the behavior of the energy sector? How does it behave during a recession? What should we expect, and are those expectations being met or not?
So there is excellent research out there on two things. One is market psychology. I think the best and most reliable commenter on that is Peter Lynch, who talks about how more money is lost out of fear of downturns than actual downturns. And so I think that's the first most important point. And frankly, Peter Lynch has actually come out publicly a number of times recently and talked about his personal investment in the oil and gas space and the energy space. So he gets it. And then the other aspect of it is specifically to oil investments, where research by Ned Davis, a leading sort of quantitative analysis provider, as well as other economic and analysis providers, what you can see is that leading into recessions, oil and gas equities and oil prices actually historically have risen substantially. And so one of the ways you could tell that you weren't really in a recession this year or late last year was that oil stocks and oil prices were falling, they weren't rising. And so the big ones that people can remember are, 2008, where you had a super spike in oil prices ahead of that economic downturn, but past cycles were similar. I mean, going into the dot-com crash, you had an oil price spike. Going into the 1970s sort of deep recessions and early 80s deep recessions, you had oil price spikes. And interestingly, when you go back even further, you see a similar pattern. So to the extent that you're really worried about a recession, oil is actually one of the better forward indicators of a recession. And you should be more worried about a recession if oil prices are rising based on past, and again, past doesn't always repeat itself, but it's really helpful, I think, as a guide. The more the oil prices rise, the more I think people should be worried about a recession. The lower oil prices are, the lower energy stock prices are, the less worried you should be. And again, we're seeing some validation of that in the data. And you're seeing whether it's politically oriented or whether it's just sort of economists being sort of negatively biased, the EIA has had to repeatedly revise higher demand. And it's sort of weird, right? Because you think, hey, you know how much oil was used in April by this point, right? Here we're at the end of June, you'd know, but you didn't. And here you have oil prices higher on this news. And frankly, this is a number of months in a row where there's been revisions higher. And so, yes, demand would get hurt in a recession for oil, and oil stocks would do poorly, but first you'd have to have them do well before they can do poorly. And so I think there's a sequencing problem, which is very relevant for public equity investors.
Yeah, absolutely. I think it's some important context to suss out here. And you mentioned the impact of political action, and we can debate. Many people could, I'm sure, how political any issue is, but the idea of energy, of clean energy incentives and clean energy legislation is something that the Biden administration has certainly made a priority. So let's talk about the impact of making that priority on the supply side specifically. The Biden administration has pushed this shift to clean energy, especially this year. This Bidenomics plan that started with the Inflation Reduction Act that had a massive impact on the potential for clean energy here in the U.S. How have those incentives and those structures and strategies toward clean energy impacted the oil industry?
So you mentioned supply, but then you're talking about something that's meant to affect oil demand and oil industry demand. So there's sort of two questions. So one is that what I observe with a background in economics and then observing sort of the reality of these plans versus what they say, you can't force physics with subsidies. And so a lot of the energy sources that are being incentivized, and a lot of these technologies that are being pushed in the Inflation Reduction Act and through other measures, they just don't work in the way that's represented. And so, for example, right now in Texas, it's about 100 degrees, or that's going to be the peak temperature today here in Houston. And what's supposed to happen, based on the various models, is about 30% of the energy being used should be coming from solar and wind, based on sort of the build outs of it. And that'll happen for, let's say, a few hours at the peak, before it actually gets too hot. Because ironically, one of the things people don't understand, it's not just cloudy days that are bad for the sun or for solar power. Hot days, heat actually reduces the effectiveness of solar panels, depending on the technology and so on. So you end up with stated capacity that's built that's much higher than the actual power that's generated from these alternative energies. And then you have similar issues with electric vehicles and other electric oriented technologies that are meant to replace oil and hydrocarbons, and they just don't work as well in extremes. And the problem is that we use energy as a society to mitigate extremes. That's why people live longer when they use fossil fuels, because you don't freeze to death and you don't die from heat exhaustion because your air conditioning works at the extremes. You need those extremes. And economically, if you aren't able to cover those extremes with alternative energy, you end up with ultra high prices for natural gas or for oil or oil products for power generation, at periods where there is that excess demand. So right now, the technology just isn't there yet to actually replace fossil fuels. And by trying to subsidize it and force it, we're actually creating a situation where, on the supply side, we're increasing unreliable supply and actually increasing the sort of swing demand for natural gas and, to a lesser extent, for oil products that are used for power generation. So it's actually not working. And by pushing the subsidies on manufacture and purchase instead of subsidizing research to actually solve the problem, I think we're actually creating a bigger problem and increasing demand. And there's a lot of data for this in terms of countries that are further along in terms of electric vehicle adoption, in terms of solar and wind adoption. And it's just not, it doesn't solve, it doesn't, what it does really well is transfer money from taxpayers to politically favored, states and governments, like local governments and companies. So it's extremely highly efficient for that purpose, but it's very inefficient in terms of replacing oil and natural gas demand. For oil demand, again, it's just the other side of the coin. When you end up using as much diesel and gasoline to power generators in states like California, I mean, you're ending up with this weird situation where, what I was saying should have been more relevant for coal and natural gas, but you're ending up with tremendous incremental diesel and gasoline consumption for diesel and gasoline power generators that are backup generators that are using right now. There's more of a concern in Texas this year. Last year and 2 years ago, it was more of a concern in California. Just, the weather is intermittent, and, you end up sometimes with hotter summers in certain places or colder winters in certain places than other places. But that's sort of where the impact ends up being. And it's very, very hard to legislate away or subsidize away physics and weather. And so that's sort of the situation I think that we're in right now.
Yeah, and I imagine, there's a healthy dose of irony in that we need this kind of energy because we have more weather extremes now than we did before, right? And I think it's probably realistic for both of us to agree that the use of non-renewable energy has had some impact on that, carbon in the atmosphere. So if we, are imagining the future of what energy looks like in 100 years, how do you imagine it? If we get really, really macro here, do you think that it's still going to be, things that we pump out of the ground and coal and oil? I mean, tell me a little bit about how you envision that.
Yeah, I think 100 years from now, I'd like to hope that we have really functional fusion reactors. And I think of the things that we have within our supply base that are sort of lowest environmental impact and highest sort of humanitarian good, nuclear seems to be the best. And again, there's the most potential over, let's say, 100 years for that to get better. When you look at the improvements in solar and wind, we're actually getting close to a point where we're getting decreasing efficiency from increasing use, sort of similar to, if you think about the very best spot to drill an oil well and the very sort of with the biggest reservoir and the most oil, well, we've already drilled all those. So now we're going into secondary and tertiary sort of fields that are less productive. Similar idea for wind farm locations, wind turbine locations, and then also for solar locations, there are better places to put solar farms, like, in the desert in between Los Angeles and Las Vegas. Like, that's a great spot to put solar. But once you build it out, there's not that next. You have to go to a less good spot, less close to demand, less optimal in terms of days of sun and so on. So I think the most potential, let's say 100 years from now, is really for fusion plus, battery technology. I think people have really odd understandings of it. The story has been that Moore's law applies, but the history has been that there's incremental gains. It's sort of, you get like 1 or 2% a year efficiency gains from batteries over the last, let's say, 100 years. And changes in battery composition so far haven't actually materially improved. They changed the sort of usefulness of batteries, but they don't actually improve that sort of overall efficiency and overall usefulness of batteries. So 100 years from now, hopefully batteries are twice as good or 3 times as good as they are now, plus, with the broader utilization, hopefully fusion technology, I think improvements there are measured in decades, but 100 years from now, hopefully we'll have solved that. And frankly, we may need a lot less oil and natural gas 100 years from now than we need now, but that's dependent on research. And again, my problem isn't with money spent on alternative energy. It's just, I think that the money should get spent on research and development to actually have technologies that work and deliver what they're supposed to, instead of subsidizing technologies that we know don't work. And, by just doing more of stuff that doesn't accomplish what it's supposed to accomplish and requires, in many cases, mining that's very polluting, and then also has humanitarian issues too. You see these pictures out of cobalt mines in Congo and other sorts of issues like that. It'd be nice to have a better solution, and the way you get a better solution is by investing heavily in research, not by subsidizing failing technologies.
Yeah, and I do not envy the people who are tasked with solving these problems. They're certainly very intersectional and complicated and have many, many tentacles. But I think it's interesting to imagine what that future looks like, knowing that we do have needs for energy. Humankind always has, and it's interesting to consider how we might get them, I think, in the very far long term. But as we kind of zoom back in here to wrap things up today, I want to get a little bit of your thoughts on the back half of this year. What are you watching? What kind of trends are you anticipating? Tell me a little bit about your market outlook for the second half of 2023.
Yeah, so I like to joke that my crystal ball is broken. So in the short term, I never really know what's going to happen. And, for example, if you asked me a year ago, hey, what's happening with oil? I'd say, hey, oil prices are probably going to stay high because of this trend. And it looked like Russian oil production was going to disappoint, and it didn't. And there were things that you couldn't really tell at the time, like oil services companies continued to provide services in Russia, which is horrible, right? Here we are subsidizing Ukraine to defend themselves, but we're also sending money and technology to Russia as we buy their oil, buy their natural gas, and help them produce it. So it's a very sort of weird, unfortunate policy that's surprising, I think, that it's sustained. And so that's sort of been that sort of surprise prevents you, I think, from effectively predicting the short term because you just don't really know. What I think will happen over the next couple of years is that this decline in shale well productivity, along with the insufficient investment longer term, is going to play out in terms of a significant supply shortage and much, much higher oil prices. That may happen in the second half of this year. Things look good. The recession that was called for hasn't happened yet. And so, and just that sort of historical research, if the past repeats itself, if we're going to have a recession in early 2024 or late 24, you would expect oil prices to go up a lot in between now and then and oil stocks to go up a lot between now and then. But I don't know exactly when that happens. And then when you look at the just pure incremental supply and demand perspective and where the consensus is for around a 2 to 2.5 million barrel a day supply deficit for oil versus a roughly 101 million barrel a day market. And so that's pretty big. And then that gets worse into 2024 and worse into 2025. The way you solve a supply deficit is through a combination of demand destruction and incremental supply. We don't have that incremental supply. That's why there is that problem. And demand's still growing, and it's growing somewhat economically or at least price insensitively. So you actually need a recession or some sort of demand destruction, not driven by price, because the price-driven elasticity of demand for oil is very low. That's sort of the economic term. But the economic activity-driven demand for oil is quite sensitive. So if you have a slower economy or a negative economy, you could have that demand shrink. And that works way better than electric vehicles. The problem is if you have a slow or shrinking economy, it hurts the poorest people, both in the US as well as the very poorest people in the world. And so it's sort of this ethical thing where do you really want to do what the Fed is doing and keep raising interest rates and try to force a recession when the people who get hurt are not the people in your or my or the Fed's socioeconomic class. It's a whole other set of people that get hurt. And I would argue that the right policy here would be to not try to squeeze supply in the short term. I think it's to try to encourage supply. And then from a climate perspective, another perspective, I think it would be wonderful to have way more of the money that's being spent on research to actually solve the problems. And then I'm not opposed to spending even more money than we're spending, but I'd like it to actually be solving problems instead of, strip mining more cobalt in Africa using child labor and then, causing all this other pollution and groundwater issues and other issues just to incrementally increase peak solar production, which again just doesn't even really solve the problem. And you end up using, I say these things and I think people think, hey, you're biased, right? Because you invest in the oil and gas industry and you're saying this stuff. But actually, these policies are net beneficial for oil prices. And in the medium term, they're actually net beneficial to oil and gas stock prices too. I think they're just bad policies, and I'd rather have fewer people suffer. And so I think it's better to have good policies that lead to reasonable investment, fewer supply issues, a less likely supply demand crunch. And it'd be nice if that happened, but it's also unfortunately not the trajectory we're on. And so I think my call, long answer to the second half, I think we do see a huge oil price spike. I just don't know if that's going to be second half of 2023 or whether it's first half of 2024 or at some point in the future. But I think the path is huge price spike, recession probably, and then settling out at a higher price than we've been for a while.
All right. Well, there we have it. Certainly quite the way to wrap this conversation up. I think it's a sage look ahead. So Josh, thank you so much for joining me today. I really appreciate your time and insight.
Thanks a lot.
Thank you everybody for listening. That was Josh Young, portfolio manager at Bison Interest. I'm Kinsey Grant. This is Leading Indicator, and I'll see you next time.